Hey everyone, thank you very much for joining us today. My name's Hugh, and I'm really excited to be introducing our two expert speakers who are bringing an absolute wealth of experience in business valuation, exit planning, and M&A strategy, Catherine and Stuart. So, what we're going to be doing is just holding on just a couple of minutes just while we fill up this webinar. We just want to make sure that everyone that's registered gets a chance to join us. So, Catherine and Stuart, how are we both doing today? Catherine, if you want to go first.
I'm doing great. Thanks, you.
Brilliant.
So ready to share some information about a topic that we can't stop talking about in the office.
Oh, fantastic. Then Stuart, how are
Yeah,
you feeling?
I'm doing well. Yeah, we're paid to talk about this stuff, so that's always good.
Well, the problem is when you start talking about it over dinner and over lunch and at home and when you're walking the dog, which is pretty much what we do.
Oh, brilliant. No, very excited for this one today. There's going to be just during the webinar as well. We're going to be asking some polls and getting some. It'd be great to get some feedback from you and just engagement. So make sure to stay on the screen as much as possible. It's going to be quite an interactive one. And also just to point out on the GoToWebinar app that we're currently on, there's a question box, as you can see in the top right, just with a question mark in there. And feel free, to ask any questions at any time. There's going to be, a period for questions at the end. But, if you want to ask during the webinar as well, that's fine. Just submit that through there, and the guys will field it at the end of the webinar. Okay, we'll just wait a minute or so just as more people join, and then we'll get things rocking. Perfect. I'm also just gonna. Right, good stuff. All right, well, I think we've got a good amount of people in here now. So over to you, Stuart and Catherine. Thank you.
Perfect. Thanks.
Okay, so good afternoon, everyone. My name is Stuart Guthrie, as Hugh said. I'm with the Liberty Group in Nevada. We're an M&A and valuation practice operating in Nevada and California. Today, the conversation mostly comes from the perspective of selling businesses and exit plan, but we believe that everything we talk about today will apply to all businesses, regardless of whether you plan to sell or not. Today, I'm joined by my wife and business partner, Catherine Guthrie, who, in addition to working on business transactions, is also a certified exit planning advisor, CEPA, in the industry, through the exit planning industry, and a value builders advisor. It will become obvious that I am overmarried. Um, our presentation today is entitled Valuation to Value, and of course, you know that because everyone responded to the invitation already. But first, we're going to talk about the difference between valuation and value. Valuation can be useful, but it won't tell us much about the value, which for the purpose of this meeting, we're defining as how much money ends up in your pocket or your bank account at the end of a sales transaction. The correlation between is actually surprisingly weak. We'll spend some time offering our thoughts on why that difference exists, and then we'll close with a brief discussion about who should be on your team as you consider an exit, because what we're really talking about here is exit planning. Ideally, you have your exit plan out of the business, your exit plan or your plan to get out of the business the day you open your doors. And I know you didn't do that because this is the third business Kath and I have owned together. We still didn't. And so maybe we can start to think about it sooner. Catherine?
As Stuart said, this presentation is geared towards those who are considering the sale of their business as part of their exit strategy. But even if you don't think you're going to sell your business to a third party, the ideas that we'll discuss today will make your business easier to manage, more profitable, and prepared for exit in case your circumstances change. Okay, so the topics for the next 40 minutes or so are going to be the difference between valuation and value. Then we're going to explain a little bit about how you can get a valuation and what buyers are looking for in a business and how that will impact your value. We'll also talk about the importance of starting the process early and the role of expert advisors in your planning process. Then we'll wrap it up and give you a chance to ask your questions.
Okay, so first we're going to start with some definitions. What is a valuation? According to NACVA, which is the National Association of Certified Valuators and Analysts, Evaluation is the act or process of determining the value of a business enterprise or ownership interest therein. The work product typically is a value or a range of values in a paper and electronic format, and typically the median value is bolded and represents where one half of comparable businesses sold for less and half sold for more. The median value is typically called the most probable selling price. So where and how do you do evaluation? First, we're going to talk about some different options. So the first thing we're going to talk about is the self-service online tools. The pros of an online tool is typically they're free, which is my favorite price. With current experience, it can be accurate, and you don't usually have to interact with anyone, so you can do it 3 o'clock in your underwear if you want, although you probably put yourself on any number of mailing lists if that's the case. The cons. As with any self-service option, the concern is always going to be garbage in, garbage out. Are you good at this? Do you know you don't need to provide any context regarding business attractiveness or readiness. They're just values calculated from numbers pulled from your accounting system. And finally, our experience with all humans, not just business owners, is that we're generally bad at coaching or judging ourselves. We tend to give ourselves the benefit of the doubt, whether it's warranted or not.
So there's other ways that you can get a free valuation. Usually this is from advisory professionals, whether those professionals are business brokers or intermediaries, an accountant, or a financial planner. Again, they're free. And depending on who's performing the valuation, they absolutely can be accurate. The cons are they're usually a way to get you to use other services that professional is getting paid for. This isn't necessarily a con, but we need to recognize the incentive structure and how important valuations are in their practice. Value can be skewed by the desire to tell you what you want to hear just because they like you and want the best valuation for your business, or they need a listing. Worst case, you get bad or incomplete information on which to base financial decisions. Valuation may not be a regular part of what they do in their daily business practices. And they may not have invested in the multiple comps databases or the more expensive resources associated with industry research and benchmarking. Ask yourself how much of their professional time they can afford to spend if they're providing those services for free.
Okay, so the last one we're going to talk about is paid valuations. And when we talk about that, we talk about either evaluations provided by a specialist or a certified valuation analyst. The pros, they're unbiased. They don't care about hurt feelings and don't care if the business is losing or not. And another pro, in our office, we believe that there are real advantages in specialization and division of labor. Valuing a business is a different skill set than providing tax advice, negotiating the sale of a business, or providing financial planning for that matter. And it takes a different set of tools in each case. If the analyst happens to be certified, the valuation is generally performed to a recognized standard, be it NACFA or AICPA, and they're going to have to maintain that certification through ongoing professional education. They usually have invested in tools, multiple transaction databases, specialized software, et cetera. Because if that's their business, they need to be more efficient at it. These valuations can, though not always, include industry benchmarking and financial ratio analysis. That makes the valuation more useful to a business owner if you're getting the report for strategic planning, although the benchmarking can be useful when we're packaging the business up for sale. If you choose to share it, it can also improve the confidence of the buyers, investors, and lenders. The con, of course, is you're going to pay. So we've talked about valuations. Catherine's going to talk about value.
So for the purpose of this webinar, we're going to define value as the amount of money that a business seller ends up with at the end of an arm's length transaction. No matter what the valuation says, if your business is not attractive and ready, you risk selling at a steep discount or potentially not selling at all, which would make your value zero. How is it possible that these two obviously related terms, valuation and value, can be so different for the same business? The difference between valuation and value, or estimated selling price versus actual selling price, is where we're going to spend the balance of our time today. To understand this variance, you have to look at a business from a buyer's perspective and realize that their concerns and the multiples that they're willing to pay for a business opportunity are directly related to risk. Valuations, even those based on accurate and detailed financial reports, don't take into account the company's qualities that make the business attractive and ready to transition smoothly to a new owner. Chris Snyder of the Exit Planning Institute categorizes these qualities into 4 general categories where you can focus to increase the saleability and stability of your business. He calls these the 4 C's, or the 4 intangible capitals. These are the features of a business that make it more attractive and less risky, which makes it more attractive to a wider, more experienced pool of buyers and investors. Your health in these 4 areas of your business will determine if you're able to sell your business or whether you'll be valued at the low end of your valuation range or at the high end of your valuation range by potential buyers. In short, they're human capital, structural capital, customer capital, and social capital. While we'll discuss all of these separately, it's important to understand that they are interrelated and codependent. Impacting one will impact the others. There's nothing magic or even new about these concepts. What's different is that Snyder organized and quantified a group of business characteristics that will not appear in the reports that you pull from your accounting system, but will cause one business to be pursued by strategic buyers and investors while another business in the same industry sits untouched on the market. So I'll start this off with human capital. The Exit Planning Institute provides a formal definition of human capital, which is the talent, knowledge, skills, and experience of employees within a business, including leadership, culture, and overall workplace engagement. For the smallest businesses on our call today, if the business is only you, you're selling a job. It might be a great job, but you're still selling a job, and your buyers will decide if having your job will be better than having their current job. But just having employees is not going to give you a pass in the human capital category. Ask yourself this: how long do people stay with your company? Are your employees sometimes more trouble than they're worth? Do your staff members get along with each other, or do they play the blame game when something goes wrong? Are you involved in every process? John Warlow calls this being the hub of the wheel. Ultimately, if you can't be absent for your business for 30 days or so without the wheels coming off your bus, your human capital needs some work and may negatively impact your business value. So I'm going to give you an example of this in its simplest form because I think it will be easier to understand. If you're a business owner operator with no employees, you have no human capital. Even if your business is producing $100,000 a year of benefit to you each year in seller's discretionary earnings, buyers will be considering whether that $100,000 is worth giving up health benefits, a couple of weeks of paid vacation per year, and maybe the ability to walk out the door at 5 p.m., never having to think about their business again until 9 a.m. on Monday morning. In addition, they won't actually be receiving $100,000 of benefit. They'll likely be giving up a significant amount of the business's discretionary cash flow to cover debt for the purchase, whether that is a bank loan or a seller carry note. Even very few buyers will pay all cash for a business. This doesn't mean that you can't sell your business. We've just sold a very nice delivery business. But remember that the 4 C's make the business attractive to a wider audience. If you are the business, then you are limited to finding a buyer with your skills and your drive. It's not impossible, but you can see that the buyer pool will be significantly smaller. When you do find a buyer, our experience has shown that you can expect a multiple in the neighborhood of 1 to 1.8 times the seller's discretionary earnings, assuming your business does well in the other areas of intangible capital. Given that the median for a Main Street business, the median multiplier, is typically around 2.3 to 2.5, you can see that a deficit in human capital lowers your value as compared to your valuation, which will be based on the median. Even businesses that have lots of employees don't get that pass, as I said earlier. If employees are driving you crazy or if you have high turnover, there are areas where you can improve. If you're still working 70 or even 80 hours per week in your business, you have to ask yourself this question: would you buy this job for a premium price or any price? It's harder to sell a job than it is to sell a business. And in the immortal words of Robert Kiyosaki, the author of Rich Dad, Poor Dad, if I have to work in my business, it's not a business, it's a job. We absolutely understand that most business owners still have a job. They play a vital role in their business. The question is really how the owner's participation in the day-to-day operations of the business impacts the perceived risk to the buyer. If someone else can step into your role without negatively impacting the success of the business, whether that's an employee or a new owner, and if they can do that without hurting themselves bodily, emotionally, or financially, then your business will be much easier to sell. In our opinion, a business owner should strive to make him or herself as invisible as possible in the day-to-day operations of the business, including sales. That means you're going to need employees. Happy, well-trained, experienced employees that are compensated at a reasonable market rate make a business attractive to buyers. Of course, employees or human capital create complexity and overhead, and they can sometimes be frustrating, like any human endeavor. But they also give an indication that a company is at least on track for independence from the business owner and ideally prepared for growth. Ensuring that your employees are happy, well trained, and stick around long enough to become experienced is at least in part the result of good structural capital. And I'll let Stuart talk about that.
I just
Oh,
just like to jump
but
in for a second, and I think it's now a good opportunity, just to ask a poll to the audience, and you just get just to get a feel really of the experience of the audience. And I'm just going to ask if you have ever sold a business. It's just a yes or no poll. It'd just be a good idea just to get an idea. So Stuart and Catherine can gauge the different levels of experience here. Okay, yeah,
kind
thank
of
you.
comports with our experience. Most people have never sold a business before. Catherine and I kind of weird in that regard.
Perfect. All right, brilliant. Thank you very much for ending that. I'll let you guys carry on. Thank you, guys.
Good deal. Thank you. So, structural capital. Again, formal definition per the exit plan. The definition of structural capital is the tangible and intangible infrastructure that supports business operations, including documented processes, technology, systems, intellectual property, and organizational efficiency. If a business owner ever responds to a question about a system, process, or documentation, they tap their temple with a sly smile and say, it's all right here. That's a problem. What are we talking about? Do you have clean financials? Meaning, do you have and do you use a bookkeeping or accounting system? And is it accurate enough to be used in management decision making? Do you have documented SOPs? How do we do these here? They're documented, accessible, and everyone in the company knows where to find them and how to use them and can reference them. We used to say that they need to be written down, but obviously that's not the case anymore because use videos, for heaven's sake, to train people. Do you have financial controls in place? On more than one occasion, our clients have discovered employee embezzlement during our financial analysis of business for sale. What do you think that does to the buyer's confidence in the business? Do you have a documented onboarding and training process for new employees? How do you get new business? How do you hire new salespeople? Do you have salespeople aside from the owner of the business? Catherine talked about that briefly. How do you decide on how much and where to spend money on marketing? Do you even have a marketing plan? Now, look, every business owner should always be working their network, looking for referral business, building a great reputation in market, which, by the way, is the last C that we're talking about today, is social capital. Everyone knows that referrals are the best leads and have the highest close rate. But what if that's all you do? How many of you heard a fellow business owner, maybe even yourself, say, I don't need to spend money on marketing because we get all the business we want through word of mouth? Or you don't have a salesperson because the owner does that for the company already and they dominate the market. I will stipulate that you are saving money on marketing dollars and a salesperson wages, but you're also paying a price. Catherine and I had a business listed for sale that was co-owned and managed by a husband and wife team, just like us. It was a good, profitable business. We generated interest in the listing and hosted buyer-seller meetings in our office like we always do. In this example, the husband and wife, the buyers were a husband and wife team as well. And they seemed to click with the sellers and things were going well, I thought. And then the buyers asked the question, how do you get new clients? Both the sellers were super proud of the fact that their marketing spend was absolutely minimal. They'd grown over the years through word of mouth and great reputation. They had a website, but they'd never spent money on promoting it, had never consistently spent any money on marketing or advertising, and still had a comfortable lifestyle. Matter of fact, it was a great lifestyle. Then the wife, who ran the operations, went even further. And in the most loving and affirming way, because she loved her husband, she talked at length about how her husband was an incredible salesman, and everyone in town knew him because he'd gone to high school there. He was a great networker, etc. And you know what? All that was true. I can confirm that the husband was a really good guy with a lot of natural charisma. The meeting ended on a high note, and I thought that our next step would be write up an offer. Unfortunately, the next conversation with the buyer was he was going to take a pass on the opportunity because he was afraid the buyer was afraid that the seller was irreplaceable, at least by him. He just didn't have the confidence. He personally liked the seller, but he's afraid he wouldn't be able to fill the seller's shoes and didn't want to bet his life savings on it. I'm not relating this story because I think that business partner spouses need to be negative about each other in public. Uh, Heaven forbid that, but to illustrate the buyer's perception of risk. In my opinion, had there been a marketing plan, any marketing plan in place, when the sellers could point to a clear ROI on a marketing spend to get new customers, the buyer might have had the confidence to move forward. And if there had been a productive outside salesperson working next to the seller, or ideally instead of the seller, the odds of the buyer pulling the trigger would have gone up even more. There's no way I can prove that, of course. I can't prove a negative, but I honestly believe that's the case. Do you have appropriate controls in your business? And by appropriate controls, what I mean is they give you visibility of the operations of your business. They allow you to delegate effectively and safely to your employees and reduce risk by making it possible to run your business by the numbers. In other words, you're more visible and quantifiable enough that you can make business decisions and make adjustments based on that data. It doesn't necessarily have to be a dashboard, or although it's great if you have one, but are your financials structured in a way that you can get critical information about the health of your business, ideally from your desk or from your home office? This usually means you've taken the time to define the important financial ratios or key performance indicators, KPIs is the industry buzzword, for your business, and ideally you've identified them for your industry as a whole. Not only will it help you run your business better today, the fact that you know what they are and track them will reduce your perception of risk to the buyer. So ask yourself, if I had to take a leave of absence, or if you got hit by a bus tomorrow, would the employees know what to do? How would that be communicated? Could the business continue to grow and operate? And would your asset be safe? Catherine?
Thank you, Stuart. So let's talk a little bit about customer capital. And this is an area where we see a lot of questions from buyers. The Exit Planning Institute defines customer capital as a measure of strength of your relationships throughout your supply chain. The primary driver of customer capital is the relationships with your best customers. This is about reducing risk and improving the stability of your top line revenue. And by doing so, you'll increase your attractiveness in the customer capital category. So I'm going to give you 3 actions today that you can take to reduce risk and increase the attractiveness of your business. The number one thing that you can do is reduce customer concentration. Questions about customer concentration are always right at the top of a buyer's list because big customers come with big risk. Don't get me wrong, everybody loves big customers, but any customer that makes up more than 10 to 15% of your revenue represents a serious risk to your potential buyer because losing that customer would significantly impact their top line revenue and potentially prevent them from meeting their financial obligations in the forms of loans or possibly even stop them from taking a paycheck. We've successfully sold businesses with customer concentrations, but this is one of the places where a seller will likely get a much lower value for their business in comparison with their valuation. The reason for this is that the buyer will discount the price that they're willing to pay in order to reduce the amount of the loan that they take and reduce their payments. That way, if they lose that big customer, it won't be as damaging. The higher the concentration, the less likely you are to be able to sell or to sell for the price that you want. Of course, another thing to consider with a big important client is that they frequently know they're a big important client and they demand significant discounts. This further devalues your business, giving you less value as compared to your valuation because you may be performing at below industry benchmarked profit margins. So one of the things that you can do to prevent customer concentration or to address customer concentration is to grow. So we're going to talk about diversifying your revenue streams. You can add related products and services, or you can take your current product or service to new markets or new market segments. The point of this is that you should have a plan for growth, whether you're executing on that plan or not. Buyers love to know where future growth will come from because they know the businesses that are growing and thriving or they're stagnating and shrinking. Having a clear idea of how you would grow reduces their risk and increases attractiveness, which will allow you to get a higher value for your business. I'll use our property management company that Stuart and I own together as my example. When we owned a property management company, our management fees were typically based on unit count or doors in property manager parlance. At the time that we got into the market in 2009, the housing market was beginning to crumble, and we grew very quickly in the single-family home segment. The reason that we grew so quickly is because we were managing houses for Fannie Mae and Freddie Mac under the Protecting Tenants at Foreclosure Act, and managing properties for homeowners who used the low interest rates and the depressed housing prices to move up. Well, because housing prices were depressed, they didn't want to sell their previous residents. They wanted to hang on to those until the market improved, so they put them on the rental market. We spent 3 years growing very quickly. The problem was at about 3 years after these houses started to come in, they all started to sell out at the same time. And the people that they were selling to, because they were single family homes, wanted to be owner occupiers. They weren't buying the houses to be rental properties. So to hedge against this sell-off, property managers were adding apartment complexes, which generally remain rentals regardless of the rental market, even though they're slightly lower profit. So using the same products and services that we were already delivering in the single family home market, we were able to expand our business and continue to grow and to diversify against the sell-off in the single family homes, which stabilized our revenue and allowed us to sell our business. So the third thing that you could do is look at creating recurring revenue. Again, with the property management company, the reason that those companies are so desirable to buyers is because they use written management agreements to guarantee that the company owns the management relationship for a set amount of time. And the money comes in month after month, the same amount. It's very predictable. The buyer has time to learn the practices of the company that they're purchasing and to establish themselves in the market while the customers are under contract. Stuart always used to say that inertia was a management company's best friend, and it's the buyer's best friend too, because if they prove competent and don't rock the boat much, it's our experience that the buyer is usually able to maintain the relationship and renew with property owners after the initial contract expires. But even without contracts, there are ways to create recurring revenue. If contracts are not typical in your industry, you could consider something like a subscription service. We sold a wine store that created a subscription wine club where their customers were billed $50 to $75 a month for a curated selection of wine. This revenue, which came in reliably on the first of every month, created stable income which covered the operational expenses of the store, reducing the risk for a new owner, which allowed us to sell the business. Another method related to recurring revenue is creating sticky customers. Especially if you have a commodity product, and if you've been in business for a while, or even if you've just been a salesperson, you've probably been told to avoid commoditizing your products because it drives prices down and allows a competitive market where it's difficult to hold on to your customers. Well, what if you're in a commodity business though? We represented a client that supplied commodity products, in this case fasteners, like literally nuts and bolts. These are items that are frequently sold by the pound, and they're a prime example of a market that could be disrupted by cheap imports like Amazon or Alibaba. So our client in order to compete and maintain their reasonable margins, integrated themselves into their customers' operational and production processes. Whether they were serving manufacturers or supply houses, our client managed their customers' inventory of these inexpensive commodity items. It allowed them to maintain their margins against competitors and to keep competitors out of their clients because their value added work benefited their customers by reducing shutdowns and out of stock situations, which impacted top line revenue and reduced the headcount because they didn't have to have employees taking inventory and managing those products, which added to their bottom line. Because our clients owned and executed on the inventory management process, it made their customers very sticky. If you need other ideas for how to create repeat customers or recurring revenue, I highly recommend The Automatic Customer by John Warlow. He talks about 9 distinct models for creating that recurring revenue.
So I'd like to interject here. An important side note that's bound to help someone in our audience today. And that is to please take a hard look at why your clients and customers are loyal or sticky. Forgive me for being a cynical one here. In the years immediately post-COVID, when business owners had engaged us to list their business for sale, our first step, as in all engagements, is a form of valuation. And what we were seeing, this wasn't always the case, but in several cases that it makes it worthwhile to talk about, we were seeing stable or even a little increased revenue, and the sellers emphasized how grateful they were for clients that had kept them afloat during the crisis. Unfortunately, we found that the margins had significantly eroded in spite of the stable or increasing revenue. The sellers knew that the bottom line were taking a hit, because they knew they were paying more for their labor and for their parts, but they took pride in holding the line for their clients and customers. And of course, it makes it easier because sometimes your clients become your friends too. In their view, they'd acted honorably toward a fellow business owner and they were rewarded with loyalty. In my opinion, a lot of the loyalty they saw was due to the fact that they were now underpriced in the market. Understand that their clients were absolutely grateful to them for maintaining the prices and no doubt said so, but why wouldn't they stay if the prices were 10, 20, or 30% below the market rates? So their sales volume stayed the same or even increased a little during the pandemic, but they were less able to afford to keep their doors open, essentially because they were being kind to their clients who were hurting too. This does not mean I'm saying that you need to be unkind or ignore your customers' concerns, but the situation happened so gradually that the business was under serious stress before they even knew it. The obvious answer is to raise prices, and while that does offer the buyer the opportunity to become more profitable right off the bat, they'll have to ask themselves if they want to be the one to take the blame for raising prices, or would they rather purchase the business with the price increases already implemented? Rather do. So, last one, social capital. The Exit Planning Institute defines social capital as the strength of your company's culture. It represents how human and structural capitals are optimized to create a flow and rhythm that self-perpetuates, driving and elevating your company to best in class. In short, this is all about communication and how people perceive your company in the community. So, series of questions again. How do you engage with the professional local community? In the professional realm, are you and your staff engaged in thought leadership in your industry or in the business community? Are you writing blogs? You're writing papers for the local business gazette and journals. How are you engaging out there to show that that you're a worthy competitor in the marketplace? What's the perception of your business by your professional peers? How about your competitors? Who's better positioned to take over your company than someone who's already in your industry? That may take the shape of a company just like yours, and they're coming from outside the market, and they want to plant a flag in your market, and start off in flight already. Maybe it's one of your local competitors who want to grow by absorbing customers and take another player off the board. Or maybe it's one of your competitors' managers. They know and like the industry, they know how it's done, but they don't see a path forward in their current company. Maybe they have the wrong last name. The discussion of how you might sell to a strategic buyer is beyond the scope of what we're talking about today, but we can say that it's done relatively frequently, and we're happy to talk to you after the webinar. So what is your reputation in your market? John Warlow talks about a company's net promoter score. Now, these are typically used by the larger companies, but it's a great way to illustrate how important it is. The net promoter score is a measure of customer loyalty that's thought to be predictive of business growth, and it consists of one question: How likely are you to recommend this business to a friend or colleague? Responses go from 0 to 10, where 0 is unhappy and likely to discourage others from using the company, and 10 being an enthusiastic promoter of the company, very likely to recommend. This measurement is typically used by larger companies that are likely to have a lot of respondents. That makes the scores more statistically significant. So an analog to the NPS that is widely considered in our experience by prospective buyers of closely held or smaller businesses are ratings posted by online review platforms like Yelp, Google Reviews, Better Business Bureau, and Trustpilot. Or in the case of service businesses, the reviews that you see on Angie or Thumbtack, those online marketplaces. So no matter your personal feelings about these sites or business practices, Catherine and I have some strong feelings about some of the review websites after being in the property management business. In our experience, these reviews will probably be considered by buyers of businesses that aren't using Net Promoter Score. So what happens if you can't avoid social media reviews or they already exist for your company? We suggest making concerted effort to turn things around as best you can. That probably means focus on getting more positive reviews to dilute the negative ones, and ideally work with a company that focuses on reputation management. That's a who, not how question. Find out who's really good at something and engage them. Understand, though, that if online reviews are a challenge for your company, you're going to be asked about it. So back again to our property management company example. Most of the prospective buyers for our property management company were already in the industry. They understood that in a tight rental market, the number of one-star reviews would be overwhelming because rental applicants were growing more and more frustrated with paying application fees and not being offered a rental house, simply because there were too many applicants for too many rental properties available. As a result, they frequently lashed out on social media review platforms. Our industry colleagues understood that, and the buyers that were just considering entering the property management business looked at our scores and wanted to know what in the world was wrong with us.
So these are the four areas of intangible capital. And I think we've done a relatively good job of explaining what they are. Well, you can be the judge of that, I guess. But why are we making such a big deal about them? Well, the fact is that even if we calculate a most probable selling price based on how businesses have historically sold, the comps databases can't tell us anything about how those subject companies performed in terms of their intangible capital, as we just discussed. If you're ready to or need to exit your business now, then we skip straight to listing your business, and you can count on us to work hard to get you the best price that we can. But if you're not ready to exit now, consider doing some value building. According to John Warlow, the founder of the Value Builder system, it takes companies 5 to 7 years for an optimal business exit. That means at the highest possible price. He's talking about larger businesses in the middle market. The initial stage of preparation takes around 2 years, and that's if you're starting from scratch. This is when you would evaluate your intangible capitals and you would work on making your business attractive and transferable. Given that you need 3 years of clear, clean financials to improve your chances of selling and to sell at the best price, the time to strengthen your financial reporting and clean up your books is now, early in the process. The second stage takes about 2 years, and clients should be focused on increasing revenue and profitability. This is, in short, getting bigger. Size plays a huge role in driving up the multiple that a buyer is willing to pay for your business. The fact of the matter is that the bigger a business is, the less risky that business is in transition. So drive up your seller's discretionary earnings, and come on now, pay some taxes. This will increase your calculated valuation. And if you want help calculating what that looks like, we're happy to have that discussion about your particular business. The next stage is going to market. That's when you hire somebody like us, a business intermediary, and we would list your business, or you would list the business, we prepare the marketing, we prepare you for diligence and work to uncover red flags. We begin the process of identifying buyers and reviewing contracts, supplier and customer agreements, and other documents so that you can head off any problems that might be encountered at close that would prevent or delay your closing. A very common issue is the transferability of leases. Um, the last 2 years are the negotiation. This is when you're talking to an identified buyer, you're negotiating the terms of your sale, and then you're working through the transition process with them because you usually stay for a little bit. So, a couple of notes on this. John Warlow is really talking about larger organizations. In my experience, this time frame is relatively accurate, plus or minus a few years. But and this applies to businesses. It's accurate for businesses that are doing over $10 million a year in top line revenue. Smaller businesses have much less to organize and will have shorter time frames. For a Main Street business with fewer than 20 employees, this time frame is more like 3 to 5 years from the time that you start working on your intangible capitals to the time that you're transitioning. But the point here is the same. Start early to prepare your business to be ready for the best possible exit when you want to go to market. How long it takes to realize an increase in value will be based on the improvements in intangible capital that you make and how strong your intangible capital is now. Are the changes that you're implementing, are they fine-tuning or are they material changes in the way that your business operates? Ideally, when you're ready to go to market, you'll have 2 to 3 years of financial data reflecting the improvements that you're making. Before you get all stressed out about perfecting your business, understand that there is no such thing as a perfect business and no business that performs equally in all areas of intangible capital. We sell imperfect businesses all the time. When it's time to sell, we do our best to get the best price for the business in its current condition. But we are absolutely confident in saying that early planning and continual improvement in the 4 areas of intangible capital will make your business easier for us to sell and will help you sell for a higher price.
Okay, so how do you know where to start and what needs to be done? Obviously, you can contact us. That's one of the reasons why we're here, is to help you evaluate your 4Cs and give you some guidance on where you can best spend your time and resources. But you're really going to need a team. I'm going to start by talking about your broker, M&A professional, intermediary. There's lots of different names for us. Not all of them can be used in polite company. Your intermediary will be focused on the business transaction. And what I mean by that is we work with other members of your team, your CPA, your tax advisors, attorneys, wealth advisors, to plan your exit as smoothly and as profitably as we can. Ultimately, our job is to walk next to you as the seller through the entire engagement, valuation, marketing, and ultimately selling the business. But recently, we've really started focusing on preparing business owners for their exit much, much earlier, ideally years in advance, which of course is why we're hosting today's webinar. We think we can do more good for more people by getting them to consider their exit a long time before it's time to punch out. What happened in the past, and I think that most people on this call have ever who've been involved in business sales, is that the owner of the business reaches a target age that's arbitrarily chosen. They say, "Hey, I'm ready. Let's get this thing sold." He's got one foot out the door. He has his already picked out. He's ready to roll. Unfortunately, the only valuation he's ever had is the one we're doing for him right now, as we prep the business for sale, and Stuart gets to tell him this baby is ugly. In these cases, it's worth less and sometimes far less that he, and what's worse, his financial planner were budgeting for. At this point, and this happens frequently, the seller tries marketing the business at the price he was hoping for versus the price he was based on the cash flow. Hey, let's try it at X. And it sits. Our focus in these webinars is to change that dynamic. We want to get that valuation done early enough, long enough before an exit, so the business owner has the time to make changes and have them reflect in the financials. Or you can choose to change the retirement plan. At least you're the one making the choice. Catherine and I and Buzz and Kelly and the other people in our office have seen way too many people back in the corner when they're already ready to retire. I'll climb off my soapbox now. Catherine?
So another person that you should have on your team early in the process is your financial planner. The typical small business owner has between 60 and 80% of his or her net worth tied up in their business. The main point of this webinar is to help business owners start to think about how they can get that value out of their business when it's time to exit. Do you know what you need in terms of assets in order to live the life that you want after you sell your business? Helping you get answers to that question and um, to plan for it is the job of your financial advisor. They'll evaluate the difference between where your personal wealth stands right now, investments, savings, and assets other than your business, so that and help you understand the total amount required to support your financial goals with respect to lifestyle and your retirement needs. When the business owner receives a this is known as the wealth gap. The difference between those two numbers, what you have now and what you need when you retire, is a wealth gap. And many business owners are counting on the sale of their business to close that gap. When the business owner receives a valuation for their business and it's the median value, they can compare what the business is worth now to where it needs to be when they retire in order to cover that wealth gap. And we can look at that in terms of the range of values and how do we push up the valuation for the business as it stands, or you can look at growing. The difference between where your business is today in terms of value and what it will be valued at the time you sell would be considered the value gap. If you believe, as we do, that your business is supposed to serve you and you're not supposed to be a slave or a captive of your business, taking time to engage with your financial advisor to calculate these values will likely have a significant impact on your retirement planning. Start soon. There's a ton of great advisors out there, but if you need a recommendation, we can absolutely get you in touch with some quality people.
Okay, so now we're going to talk about your attorney, and I will abstain from making lawyer jokes. Most business owners already have a relationship with an attorney, or you absolutely should. As you consider exiting through a sale to a third party or otherwise, we strongly encourage you, business owners, to talk to your attorney regarding their specialization. And what I mean by that, have they done transaction work before? Are they comfortable with it? Do they have a focus in a background regarding business transactions? An attorney specializing in transactions will review your documents, sales documents and otherwise, write specific terms that are not included in stock contracts, and memorialize the addendums. And probably most importantly, they'll be able to explain how the terms of the contract will impact you during the sale, and most importantly, after the sale. This is especially important if you're being acquired by a large, sophisticated buyer who's proposing a complex deal structure. Our experience, we call these folks strategic buyers. They're already in your industry or a related industry. And if they're much bigger than you, and ideally your ideal acquire, according to John Warler, is a business between 5 and 20 times your size, they'll have a preferred deal structure, and they have attorneys either on staff or on retainer that know their preferred model inside and out. And I can guarantee you it's going to be favorable to the buyer. You need an attorney on your side to parse that out. Make sure your attorney is open to working with the rest of the people on your team, your intermediary, your tax advisor, your wealth manager, to facilitate the deal in a way that's most beneficial to you personally. Again, your business is supposed to serve you. You're not supposed to serve your business. Finally, know that your attorney is not just negotiating your sales contract. Do you know if your leases, your vendor agreements, your intellectual property, your client contracts are transferable to a future buyer? Catherine noted earlier, the thing about the leases. Leases have derailed a lot of sales when we found out that they couldn't be transferred. So you need to start that years in advance, engage with your attorney early and often if you think that an exit is in your relatively near future. We're talking 2 to 5 years. Catherine?
So the last person on our list is your tax advisor. Um, Almost everybody has a CPA. We hope you're using an accounting professional to help you with your taxes if you're a business owner. But what Stuart shared about legal counsel and the importance of making sure that they have the skills and knowledge that you need in a business sale transaction is also true for your accounting and tax planning resources. Talk to your CPA and accountant about their comfort level and desire to work on a transaction. Some CPAs are great. Many of them are, especially for large transactions. You might want to be getting tax advice early that can save you a ton of money. And make sure that if your CPA or accountant says yes, that they'd like to help you, make sure that they'll be able to give you timely assistance during tax reporting season when they may be facing extreme deadline pressure. So taking the time to engage in tax preparation and modeling, and modeling with respect to the impact of deal structure, will make you more confident in negotiations and can have a major impact on what you get to keep after the sale of your business. I'll give you a quick example of that. We have a client who wanted to sell their business. The business is very profitable. It has good employees, it has great structural capital, their books were in order, they're growing. And as we got ready to list, I asked if they had discussed the potential transaction with a tax professional who specialized in business transactions. And this was a larger transaction, so they were really looking at needing a specialist. They'd not done that, so I recommended an excellent resource from our professional network so that they could get an understanding of how deal structure might impact their taxes post-sale. This is one of the benefits, by the way, of using a business intermediary in a transaction. We have the experience to anticipate potential issues and to bring resources to the table to help you get the most out of your deal. So in our conversation with that tax advisor, I happened to mention that my client's books would reflect a change to a C corporation filing about 4 years ago. Turns out there's this rule, Code Section 1202, which allows for the exclusion of capital gains from the sale of qualified small business stock held for more than 5 years. By delaying the sale for 9 months, or by delaying the listing for 9 months, there would be no capital gains on $8 million of sale price for this client. This also gave the owners time to polish up their business and be ready to transition. This conversation also addressed shareholder notes that they had on their balance sheet and some other issues, which allowed them to be prepared for the transaction. So it saved them $1,500,000 in taxes. I think it was worth the money that they spent to have the conversation. So here's a little secret about exit planning. Exit planning is really just good business strategic planning. All the characteristics that will make a business attractive to a buyer are the same identical characteristics that make a business better, more profitable, more pleasant to run, and take less of your time. The day that you walk into your business and ask yourself or think to yourself, hey, this is fantastic. Why would I sell this business? It's great. This is the day that you may want to list, because buyers will pay you a premium for a business that you don't want to sell because it's operating smoothly. There's far more to exit planning than we've been able to present here, but it's too broad a subject to cover in 40 to 50 minutes of a webinar. Rather, our intent in hosting this meeting today is to start you thinking about how a buyer will view your business when you're ready to exit, while you still have time to make those adjustments that will make your business more attractive and more valuable in the marketplace.
Okay, thanks, Catherine. So thank you for joining us today. We hope you found the insights valuable, and hopefully we scared you into think about exit strategy. If you're ready to list your business, or you think that selling your business in the future might be a reasonable option, or if you just want to see how our business measures up in the 4 intangible capitals, reach out to us. We'd love to talk to you after the webinar. Now, I guess Hugh and Jean, we're going to open up the floor to any questions.
Yes, absolutely. Thank you so much, Catherine and Stuart. That was fantastic, and really valuable insights into how early exit planning, can protect and maximize the value of your business. So thank you so much for that. We've got about 6 minutes here just to answer any questions that you may have. Just to remind you, the question box is in the top right corner with the question mark inside of it. So feel free to ask any questions and we'll field those now. Just also to let you know, if you are interested in booking a time with Stuart and Liberty, the Calendly link is in the chat there. I've just pinned it, so feel free to find a time that suits you. Just as we're getting questions coming in as well, I'm just going to ask a quick poll, and that is, when it comes to selling your business, which approach are you most likely to take? So it's just a simple question, basically. If you'd rather sell by yourself, or you'd like to engage a professional, and it's just good to get an insight on that. Thank you very much.
Oh, that's what we like to see.
Yeah, That's it. That's what you want.
Thumbs up.
Oh, someone's going to sell it by themselves.
Perfect. If anyone's got any questions, feel free to put them in that box there. We'll just look at that now. So we've got a question here. So in terms of selling the business, if they're interested in working with Liberty, do you tend to meet in person? When like to start the process, or how does that usually work?
If we can define a Zoom meeting as in that's easy. But no, I mean, um, if you look at my bio, I have evidence of severe lack of focus, um, meaning that I've done a lot of different things. I am fascinated by going out and talking to people at their place of business because I want to find out about their place of business. So I've worked in telecom. I was in the military. I industrial work. So if I can pull it off, I'm coming out to see you. Um, but you know, the first many meetings can be done. That's one thing that COVID did for us. It made this sort of communication much more acceptable. So short answer is I can be very flexible.
Yeah. Oh, perfect. That's fine. And then in terms of locations as well, of businesses, where you have the ability to sell, if you just want to touch upon that as well.
Sure. So there are 18 states in the nation that require uh, business brokers or intermediaries to have a real estate license in order to practice. Two of those are Nevada and California, which is where our two offices are located. I couldn't name all of them off to you right now, but here's the thing: give me a call regardless, and if I can't help you, Catherine and I are heavily involved with our trade organization, and we can get you connected with really, really good people who can help you, even if you're not in our territory, but certainly in Nevada, California.
Yeah, and I would just add to that. We're selling businesses. We have current listings in California. We have current listings in Nevada, and we're working on a deal with a partner in potentially in Atlanta. So we really do have the ability with our network and with our licensing to help you, regardless of where you're located, whether that's through a referral or whether that's helping you personally.
Yeah, perfect. Thank you. And we've got another question here. So, what is the average cost or percentage business brokers typically charge to sell a business?
Can I
That's
address?
gonna
Can
go
can
ahead.
I address this?
As a broker, you bet, Catherine. Go ahead.
So it's really hard for us to nail down a percentage for you because businesses are sold based on size. So for it, at the highest percentage that we work with, unfortunately, that's what the smallest business is because it's the same amount of work or more. So if your business is under $1 million, you can count on brokers charging somewhere between 10 and 12%. But that percent goes all the way down to around 5% if you're talking to a multi-million dollar business. So you
A
really,
multi-million dollar sale of a
a
business.
multi-million dollar sale, yeah. So you really we need to talk to you on an individual basis. And again, we're governed by the Board of Realtors. So, um, you know, I don't want to encourage people to negotiate my fees, but commissions are negotiable. So we want to talk to you on an individual basis.
And then just final question here as we have a minute left. How often does someone strategically buy a business in the same industry?
Depends on the
Um,
size of the business.
yeah, I mean, it just depends. That's the interesting thing about our industry is that if you stand back and squint, it looks like a real estate transaction because there's a buyer and a seller and something to sell. But the fact is, that's where the similarity ends. Um, it really depends on the buyer. In other words, what is their plan? Um, it depends on the industry too. In other words, for instance, we've seen a lot of roll-ups in the trade businesses. Whether it's HVAC and plumbing businesses, a lot of people are wanting to get those, collect those up and bring some scale to those businesses and efficiencies in the back office operations that we're seeing. So it happens a lot, doesn't always happen. I wish I could be, I don't think it's possible to be more vague than that, but unfortunately, that's really the answer.
Yeah. Fantastic. Okay, brilliant. Well, again, just a huge thank you, Stuart, Catherine, for sharing, your expertise and your knowledge with us today. And thank you, everyone, for engaging and attending the webinar. What we'll also be doing is sending through the recording, so you have that available, and then also the booking link too, so you can meet with Stuart, if you'd like to discuss that one-on-one with them as well. But yeah, over to you guys. Thank you very much, and yeah, we'll leave it with you.
Thanks so much, Hugh. We appreciate it. All right.
Yeah.
So,
Thank you,
yeah, I think
everyone.
that's about it. Appreciate it. Take care.
Thank you, everyone. Bye-bye.
Bye.